the top of my head, I didn't expect the reaction that I got with quite a couple of people who said to me, we shouldn't be donating money to SARS, but yet we do. Hence, we're having this discussion. I think in previous talks, we've spoken at length, and you've probably seen the communications that I've sent, that there's a definite need for a diversified portfolio. We need to remain calm in times when the market's tough, and we need to stick to our financial plans. And one of them is saving, and saving sensibly. I know most of us have share trading accounts and so on, but we also do have retirement annuities, and we have preservation funds, and we also, some of us have tax-free savings plans all together. So I wanted to touch on the topic of partnering with SARS to make more of your investment. All right, I'm going to share my screen and take you to the presentation. There you go. You should all be able to see that now. Righty, let's jump straight into it. Let's go down to page 2. So the first way in which you can partner with SARS is through your retirement savings. Let's go through the technicalities of the product quickly. You are allowed to save towards retirement the greater of your taxable income or your remuneration. The difference is simple. Remuneration is what your employer pays you. Taxable income, stuff like your rental flat, and that the income out of that gets added to it. So your taxable income is typically larger than your remuneration. Now you are allowed to save 27.5% of that taxable income or remuneration into a retirement product, but it's capped at 350,000 per annum. Right, so it's quite a bit of money that you can save every year towards your retirement. Quite important. So I've stuck a picture of a brochure that we have on our website that you can go have a look at. And on the right-hand side, I did a simple calculation. I said, this is a guy that's 40 years old. He'd like to retire at 65. At that stage, in today's money, he would want 40,000 Rand a month. And he would want that to typically last for 30 years, hoping that he'll attain the age of 95. Right? So he's pretty certain that he'll have that income going forward. He has saved up 2 million in his retirement savings up to this point, and he can afford to contribute 1,000 Rand a month towards a retirement annuity. So on the right-hand side, you got the results. And for this guy to retire at 65, he needs to make a contribution of 5,233, not $1,000. His savings of 1,000 Rand a month will result in an income of 29,219 if added to his 2 million that he saved already. Or he can choose to work until he's 70 years old. Now, I'm going to show you how SARS can sponsor you and help contribute towards your retirement. Look, we've all heard the saying, pay yourself first. And I agree that we all work hard, and if you get your pay, you should be taking some money and rewarding yourself. It's nice to buy yourself something, but we should be looking further than that. And I think McDonald's has stuffed it up for us, because they deliver our food to us in 30 seconds, and now we're expecting everything else in life to happen quickly. Unfortunately, retirement's not going to happen quickly. Saving towards retirement is not going to happen quickly. And we're all going to end up in dirt if we don't make a plan to try and save for it. So what I did on the next page is I calculated some savings for you. I took the same guy who was earning 500K a year. His marginal tax rate is 36,000. And I said, fine, if his monthly income is 41,667, he makes a pension contribution of 5%. His employer makes a contribution of 5%. His monthly tax would amount to 7,900, and he'll take home 31,660. That makes his annual net salary about 380,000. His annual tax payable is 95,000. So this guy will end in his pocket with 284,823. Now we take that same guy and we say, fine, he's still earning 41,667. His employer is contributing 5%. He's contributing 5%. But now that's 10%. He's gone and calculated what is the other 17.5% of my taxable income. And he's paying that into a retirement annuity. So he's paying himself, but he's paying himself forward. His monthly tax would reduce to 5,664. Yes, his net salary drops to 26,600, which is 5,000 Rand less. His annual net salary drops to 319, and his total tax payable is now 68,000 versus 95,000. He's got in his pocket 251,000. The other guy's got 284,000. But if you think about it carefully, what's his? It's the 251 plus all the money he saved in the RA, plus that 7,292 per month, which makes up 339. So he's in a far better position than the other guy who did nothing. That guy essentially donated this 33,000 because this is the portion of the annuities premium that the receiver is funding you with, because he's allowing you to deduct that amount from your taxable income because of the contribution that you've made. And that's how I came to realize that we're donating money to SARS. If we don't use these instruments and make use of maximum tax savings, we're just wasting, right? So that's just a quick calculation there for you. The other way of saving money would be through tax-free savings. We all have a tax-free savings account, right? And you might say, how is that, Sarel? We have an interest exemption from SARS, which says on the first 23,000 odd, I don't have to pay tax if I earn interest on an investment. If I'm under 65, if I'm over 65, I'll get even more. It's 35,000. So I do have a tax-free savings plan of sorts. But let me quickly highlight one or two product characteristics of a tax-free savings account. You're allowed to contribute 36,000 Rand per year. And you're allowed to contribute over a lifetime. You have a limit of 500,000 Rand. Any growth within this product is tax-free. Now, when you contribute, and even when you stop contributing. The premiums are not tax deductible, so it's being bought with after-tax money. But the growth on the money is tax-free. Let me show you what that looks like. I've done the spreadsheet, and I've said, fine, at the end of year one, after contributing 36,000, and at a growth rate of 10%, which gives me 3,600, I would have 39,600. Right? If I was to cash it in, and it was, argument's sake, in an endowment, which paid 30% tax, I would have had to pay 1,080 Rand in tax, which left me with 38,520. If I then let this thing run, and I contribute 36,000 Rand per year, as I'm allowed to, all the way down to year 13, where I would hit the 500,000 contribution mark. I would have in my tax-free savings account 882 versus the guy who wasn't saving in a tax-free investment. If he cashes out, he's going to end up with 731,000. So it's silly. You know, if you are using your interest exemption of 23,800, right, then the other thing that you can do is structure your investment such that you make use of the allowance that a tax-free savings account gives you. Bearing in mind that the tax-free savings account, in my mind, is a long-term investment. Imagine having attaining a 12% growth rate. And at the end of the 13 years, once we've contributed our 500,000 lifetime contribution, we're sitting on $1 million. And that R1 million then grows tax-free from there on for the next 20 years. We'll have a big sum of money. So really important to look at your individual situation, assess whether you are using your interest exemptions. If you are, then you should consider making use of a tax-free investment. But the primary thing that you should be doing is checking up on your retirement savings and making sure that those RAs are paid to the max that the receiver allows you to pay into them. What I've done is I've put some resources up here on the presentation with links where you can go read more about tax-free savings plans and our key information doc on our retirement annuity. I've also put the link to the calculator. There's a space where you can register for an investment if you don't have one. And then obviously we've spoken in the past about the funds we've created specifically for you guys to help your fund choice, simplify your fund choice, being the PSG Multi-Management Growth Fund, which is the aggressive one, the cautious one, which is the stable investment one, but there's some equity exposure, but mostly cash instruments, and then obviously the income fund. Lastly, the income fund, which is, as the name says, based more money market based instruments or cash instruments. And that, in short, is my story. Remember that investing in a PSG fund on a PSG platform will attract lower platform fees. So important to also consider using a PSG fund when you're investing on our platform. I'm going to jump back to the main presentation screen, and then I want to quickly run a poll with you guys, like we did last week. Just want to load it here. That was last week's stuff. Okay. So I want to know how many of you, and this is not a trick question, I also had to do some real thinking. How much is needed for me to retire comfortably? How many of you know the answer? And how many of you are hoping that it'll be enough? I'm going to put the poll up. You should be able to see it now. Right? How much is needed for me to retire comfortably? I know the answer, or I'm hoping that there will be enough. You simply pick your option, and then click on submit. Let's give it another couple of seconds. Right. Now, I see there's a couple of hours of us that are keeping a close eye on cat food and the prices, because there's a couple of us that's hoping that we have enough. But there's also 34% of us that know the exact answer. Well done to you. Guys, it's crucial for us to understand how much is needed in order for me to retire comfortably. And I want to invite you to contact us, contact our investment specialists, to send us a mail at wealth@PSG. We can send you to an advisor if you need to go to an advisor and get a complete picture of your financial situation, or you can simply contact us and we can try and help you as far as is possible to get that answer and to see how you can structure your current RAs and pension savings so that you get the maximum subsidy from the receiver of revenue. The second poll that I wanted to ask is, I wanted to know whether you use every cent the receiver allows you to reduce your tax burden, right? No. And the answers there are, I am saving the maximum allowed towards retirement. I should evaluate my situation and contribute more towards retirement. Or I know a place with cheap cat food. That's just tongue in cheek, guys. I really want to understand, am I saving, I am saving the maximum, or I should be evaluating my situation and contributing more towards retirement. So click on your option and say submit. Let's see what that comes to. I think the answer is obvious. All right, so what these results tell me is that a lot of us do need help, and I can expect a lot of emails at wealth@psg.co.za coming in this afternoon. But what I'm going to do now is I'm going to throw the floor open and then you guys are welcome to ask me questions. I'm going to put the presentation back up in case you have questions relating to that. And I will also post the PDF of the presentation. I will gladly post that for you in the chat box. Sorry, I see if I share this presentation like this, then I lose the ability to see you guys. So let me rather do that. All right, let's not share. Oh, wait, I can share, but now I've lost the presentation. Be that as it may. Fire away, guys. Let's see if we've got some questions out there. I'm going to go to the chat room and see the questions. Okay, great stuff. So Derek says, should one invest in a tax-free account if your annual interest received is less than the interest exemption? Derek, I would say no, because you're already getting that exemption. So nothing to be done. If you're investing and your interest earned is less than the exemption, then there's no need for the tax-free savings, because the growth on that interest exemption would be sufficient so that you don't end up paying tax on the interest earned. Vessel says, is the multi-management fund available as a fund for a retirement annuity? It is indeed, Vessel. All three, the multi-managed funds, the growth fund, the cautious fund, and the income fund are all three Regulation 28 compliant, which means that they may be used in a fund towards saving towards retirement or any retirement product. Remember that we've spoken now about retirement annuities, but in the same boat is preservation funds, so that if you leave your current employment and preserve that cash somewhere, you can also put that with PSG. So those of you that have yours at Allan Gray and that, you can put everything together at PSG and make use of stuff like family aggregation, where we take all of your investment products, add the totals together, and then you end up paying less fees. And if you're using a PSG fund inside of those products, even better, then your costs come down further. Clive says, Sarel, please share the link to the presentation. Thank you. Clive, I won't forget. I'm going to do it as we speak. Let me go here and say, oh, no, not important. I want to attach a file here. Okay, guys, I will figure that out in a short while. I cannot for the life of me now. Let's see, more meeting requests, polls. Let's see the chat. I will add that. I will add that to the. Definitely add that for you. I just don't have it at hand now. Okay, let's see. I was with Roland, right? Roland says, you could still invest. You would earn dividend, interest, and capital growth tax-free. You're right, Roland. You're absolutely right. So that's coming back to the answer, Derek's answer of should he invest if he hasn't used up his whole interest portion. Roland is right in that in a tax-free savings plan, you do not pay dividend tax and you do not pay CGT. So the only portion that we touched on was the interest earned. Roland is right. You could still use the tax-free savings plan. Derek says, which investment instruments are best to have in tax-free account? Bank investments or ETFs? Because of my point of view that I think it is a long-term savings vehicle. Let's say you're 60 today and you start contributing. At 75, you'll hit the maximum that you can put in there. And then you leave it as the last resort to start withdrawing from it for retirement income to get the maximum benefit out of it. I think you should go aggressively and have something like our PSG multi-managed growth fund in there. I wouldn't necessarily have a bank investment in there where I'm going to get 6 or 7%. I would rather take a chance because I'm spreading the love also. I mean, every year I'm contributing, so I'm getting the benefit of cost averaging too. Hope that answers your question, Derek. And then Swedish says, within a tax-free account, are the capital gains also free of tax? Yes. Roland reminded me of that. Dividends, interest, and capital growth are tax-free inside of a tax-free investment plan. Right? Carl says the example spans over 13 years to save about 100,000. No, the example over 13 years takes me to my 500,000 because I'm contributing 36,000 per annum. I think it's 13.89 to be technically correct, Carl. It's 13.89 years before I reach my lifetime limit of 500,000 that I'm allowed to stick into a tax-free investment plan. On an RA, just a reminder, I can stick 350,000 maximum per annum. So that's quite a bit. Any other questions, guys? Yes, wait, it shows new messages. Let me scroll down. All right. Ronald says, I don't like that an RA traps your savings in South Africa. So if I immigrate, I have to have an living annuity here paying me offshore. Ronald, yes. An RA does, in a sense, trap your money in South Africa, but I mean, remember, it only traps it for 3 years under the new legislation. Right? After that, you can cash in the full amount if you financially immigrate. You don't have to have an LA that keeps paying you offshore. You could actually financially immigrate and then cash in all the savings. James says, can one pay your contribution as a lump sum for the year to gain the tax benefits? Absolutely. James, if you were supposed to make your second provisional payment now at the end of February, and you made a payment towards a retirement annuity, you can take that off your taxable income, and that would reduce that second provisional payment that you're making. So yes, it can be done in that way. And then, are there any limits to how many RAs one can have? Can I buy the max 350 RA every year? Yes, Paul, you can, and you should. If your income, if that constitutes 27.5% of your taxable income, you can get the full tax benefit. Remember, whatever you over contribute into an RA gets carried over to the next year. And if it's still not used there, it goes over to the next year. And let's say you retire in year 4, whatever cash was overpaid can be added back to your lump sum, your maximum lump sum of 1/3, with the first 500 being tax-free. Let's say, Roland, I think in a sense that answers your question. If we invest more than 350, say 450, SARS keeps a record of the extra 100K. So you get to use that next year, or you get to use that when you eventually retire from that product, and it gets added to your lump sum. All right, Michael says, if I have a tax-free savings account running for, say, 5 years, what happens if you switch to a new product? You can withdraw the money at any time from a tax-free savings account without having to pay any kind of tax. That's the short answer, Michael. James says, thanks. And Louis says, can you please share the link again? Louis, at this stage, I have a problem in that I don't know how to get the link onto this chat now. But I will certainly stick it into the chat once we close the meeting. I just, for the life of me, cannot figure. Yeah, this is where the attachments go. No. All right, I'll try and figure it out. Otherwise, I will keep the meeting alive until such time as I figure out how to put it up there. Or send me a quick mail at wealth@psg.co.za, or you can send it to my inbox, which is sarel.snyman@psg. And I'll quickly send you the file as well, Louis. Sorry, man, I'm having a brain fart here regarding the tech that I'm using. Okay, Swedish says the one risk that's becoming prevalent is that the government may issue a new tax thereby taxing the RA funds sitting within the RA. Is this a possibility? Swedish? I think somebody's talking with me. Yes, Marius. Marius is unmuted and he's answered the question.
Sorry.
He says it's always a possibility.
Apologies.
No, you're welcome, man. It's nice to have someone talk with. The possibility is always there. I mean, governments do irrational things, but they have been for a very long time encouraging retirement savings and tried to make it as lucrative as possible for you to invest in those products to save tax and get off their social grant payment list. So they may impose a tax on the rich, but I doubt whether they'll do it as far as retirement savings is concerned. That would just be really stupid. I don't foresee that in the near future. Guys, any further questions? If there are no more, yes, Ronald, did you want to ask a question? No, I just saw Ronald's mic went unmute and then mute again. Dennis says, right, do you have a calculation of the tax savings, but also including the tax paid when withdrawing from the RA? I do not have an example in this presentation, Dennis. But if you contact me, I can help you with that calculation. It is quite simple, as I've said. An RA pays you 1/3 of the money inside of the product as a lump sum, with the first 500,000 being tax-free. And then if you retire from it, you will be taxed at the retirement tax tables, which are a bit more lenient than the normal tax tables. So it's quite a simple calculation. I can help you with that, Dennis. If you pop me a mail then with your specifics, then I can try and help you as to how to structure your retirement annuities 1/3 lump sum, the most tax efficient way. Anything else? Last of the lasts? Nothing. So in summary, guys, we're sponsoring the receiver of revenue with taxes that we don't need to pay. If we contribute the maximum to our retirement annuities, we make maximum use of the subsidy that is giving to us. If we save inside of tax-free wrappers, like the tax-free investment plan, we're saving on interest, tax on interest, tax on capital gains, tax on dividends. If we park those funds in a PSG product on our platform, we're saving on platform fees. So a lot of things to chew on, a lot of things to contemplate. We're coming up to the end of the tax year, and paying into your RA is one of the things that should be forefront of mind. And if you don't have an RA, we'll gladly assist. Remember, our email address is also in the chat at the top. It's wealth@psg.co.za. Thank you very much for your time. Next week, we'll be having a chat about the offshore stocks again. Thanks very much for joining us. It was great having you around, and thank you for participating and sending us a lot of questions. Look forward to talking to you. Cheers, guys.